Welcome to the Physician's Guide to Financial Wellness, the podcast dedicated to helping physicians in Michigan turn their professional success into financial success while enjoying life along the way. And now, here are your hosts, Andrew Mushbaugh and Trent DeBruin.
Hi, everyone, and welcome to another episode of the Physician's Guide to Financial Wellness. This is Trent DeBruin, and I'm joined, as always, by my co-host, Andrew Mushbaugh. And for today's episode, we're going to share our year-end tax planning checklist. So as we head toward the end of the year, these are some of the specific things you can do between now and year-end to either save on taxes or just be more tax efficient for 2021. And Andrew, I know we've talked about tax planning on prior episodes, so just to check, have you managed to find that silver bullet yet where people can avoid taxes altogether?
Yeah, you just have to hire Donald Trump's account or give everything away.
Yeah, those both seem like practical and realistic options.
Exactly. We knew we'd find that silver bullet eventually.
Well, outside those two great solutions, unfortunately, there's a limit to everyone's ability to avoid taxes. And as a physician, you'll end up paying more in taxes than the average person given your income. However, there are a number of ways to reduce the amount of taxes you pay, which we'll walk through. So Andrew, why don't you start out by touching on the biggest one for most people, which is contributing to your employer's retirement savings accounts.
Yeah, and before we walk through some of these specific areas to save on taxes, it's important to not let the tax tail wag the dog. Remember, if you're like most people, you'd rather pay $5 in taxes and have $10 in your pocket than pay $2 in taxes and have $3 in your pocket. So having some perspective helps, and just like the realities of investing, at some point you have to accept the reality of making more money equals paying more in taxes. And having said that, there are several things within your control that you can do to pay less in taxes. So as a starting point, the area with the most potential to save on taxes is through the various retirement account options that you have. Looking at this as an employed physician, you'll have access to either a 401k or 403b, a 401k if your employer is a for-profit company, and a 403b if your employer is a non-profit or government entity. On top of that, another common retirement plan offered through some of the local employers is a 457b plan. And these accounts allow you to contribute money to them, and if you make pre-tax contributions rather than Roth contributions, you receive a tax deduction for your contributions. In other words, the money you contribute reduces the amount of money you'll have to pay taxes on today, and therefore lowers your bottom line tax bill. Each account has a limit to how much you can contribute each year as an employee contribution, and therefore the size of the tax deduction you're able to receive. For 2021, the employee contribution limit is $19,500 for a 401k, 403b, or 457b plan if you're under the age of 50. But if you're over the age of 50, you're able to make an additional catch-up contribution of $6,500, which means you're allowed to save $26,000 in total. And keep in mind that this limit applies to each account type, one for your 401k or 403b account, and a separate one for your 457b plans if eligible. For example, at the University of Michigan, they offer both a 403b and a 457b plan. So if you're a U of M physician who's under age 50, you can contribute $19,500 to each of these plans in 2021, or $39,000 total. If you're over the age of 50, then it's $26,000 each, or $52,000 in total. So you can see how significant these tax deductions can be, and why this is the first place you want to look when trying to cut your tax bill as an employed physician. And just to quantify the potential tax savings here, if you're a physician under the age of 50 in the 32% marginal tax bracket, making that $39,000 contribution, you'll save or defer paying taxes on more than $14,000 in total income taxes when factoring in federal and Michigan taxes. If you're over the age of 50 and contribute the maximum $52,000, those tax savings jump up to almost $19,000. So for the purposes of our year-end tax planning checklist, the first thing you want to do is check whether you're on pace to make those maximum contributions to each of those accounts. If you find that you aren't on pace to do this, and you have the desire and ability to make the maximum contributions, this is a great opportunity to increase your contributions for your remaining paychecks before the end of the year. Now, there are several other accounts out there, especially if you're in a private practice, like a cash balance plan, 401k profit sharing contributions for partners, and those allow you to save even more on taxes, along with other retirement accounts like I-401ks or SEP IRAs if you have any side income from consulting, moonlighting, writing, or speaking. But these aren't always as widely applicable, so we don't want to dive into the details here. But the main takeaway is to be aware of all the potential retirement plan options through your employer, and know that taking advantage of the maximum allowed contributions is the biggest driver in reducing your overall tax bill for the year.
And keeping on the topic of employer benefits, the next item on our checklist is reviewing your health savings account contributions, assuming you're eligible to contribute to this type of account. Now, as we've talked about in prior episodes, not everyone has access to a health savings account, or HSA. In order to have access, you must be enrolled in an eligible, high-deductible health insurance plan, which not every employer offers. For example, of the big employers in our area, U of M doesn't offer one, but Beaumont and Henry Ford do. But assuming you do have access to an HSA, this is another great way to save on taxes. The way an HSA works is that you contribute money to it and receive a tax deduction for your contributions. Then once the money is in the account, you can either withdraw it tax-free to use to pay for out-of-pocket healthcare costs, things like deductibles or copays, or you can invest the money and let it grow tax-deferred for the future. If you invested and later withdraw the money for healthcare costs, it comes out tax-free. But at age 65, you can also choose to withdraw it for any type of expenses. You just have to pay taxes on each dollar you withdraw, similar to a pre-tax 401k, 403b, or 457. So in that sense, you can view an HSA as another retirement savings account, but one that's even more attractive than your regular employer-provided retirement savings accounts, since there's the potential for a triple tax benefit: tax deduction, tax-free growth, and tax-free withdrawals if you ultimately use the money to pay for healthcare. Although it's worth noting that you can't use HSA money to pay for health insurance premiums, such as private health insurance between retirement and Medicare at age 65, or Medicare supplemental insurance after age 65. So keep that in mind when thinking about it as a bucket of money for paying for healthcare in retirement. The only health insurance premiums you can use it to pay for are COBRA if you leave your job and keep your old employer's health insurance coverage for a certain period of time. But regardless, if you're eligible to contribute to an HSA, this is another attractive account to contribute to and a great way to reduce your tax bill. Similar to employer retirement accounts, you're able to change your HSA contributions at any time throughout the year. So for this item in the tax planning checklist, you'll want to confirm whether or not you're on pace to make the maximum HSA contributions. Also similar to employer retirement accounts, there are limits to how much you can contribute to an HSA each year. And for 2021, this limit is $3,600 for an individual or $7,200 for a family. There are also catch-up contributions for people aged 55 and older, so if you fall into this category, the limit is $4,600 for an individual or $8,200 for a family. It's also worth noting that these limits apply to the combined employee and employer contributions to an HSA. Most employers that offer HSA-eligible health insurance plans also make a contribution to the HSA accounts of employees who choose these plans. For example, it might be something like $500 or $1,000 per year. So when thinking about the money you can contribute to your HSA, be sure to take into account the employer contributions. For example, if you're under age 55 and eligible to make the maximum family contribution of $7,200, but your employer contributes $1,000, then you're only allowed to contribute and receive the tax deduction for $6,200 of your own money. And just to quantify the potential tax savings of an HSA, if you're under 55 and in the 32% marginal tax bracket and able to contribute the full $7,200, between state and federal taxes, that would save you around $2,600 of taxes. If you're 55 or older and able to contribute $8,200, those combined tax savings increase to almost $3,000. So step 2 in our year-end tax planning checklist is, assuming you have access to an HSA, checking to see whether you're on pace to make the maximum contribution, and if you aren't, but have the ability to and it makes sense for your situation, increase your contributions for your remaining paychecks for the year to hit that maximum amount.
Yeah, so that covers a couple of the employer benefit-related items when it comes to year-end tax planning strategies. And we essentially view your retirement plan accounts and the HSA as 2 retirement buckets. But we know there are other goals you may be saving for, which often results in additional ways to save on taxes. So the next item to review on your year-end tax planning checklist is relevant if you're saving for college costs, but can also be relevant if you have more than $10,000 of student loan debt, which is making contributions to a 529 plan. And we have an entire episode dedicated to saving for college, episode number 4. So be sure to check that out if you're interested in diving more into the weeds in this area. But for the purposes of our year-end tax planning checklist discussion, we'll keep it focused on the tax benefits. So to give a brief overview, a 529 account is a tax advantage account that was initially set up to allow people to save and invest for higher education costs or qualified education expenses in a tax-efficient way. While this was traditionally designed to benefit those saving for college and graduate school costs for their children, the definition of what constitutes qualified education expenses has expanded throughout the years. It includes paying for college tuition, but also things like room and board, books, fees, and even equipment such as computers. On top of that, more recently, it has been expanded to include paying for up to $10,000 of student loans and private K-12 costs. Although, unfortunately in Michigan, using a 529 plan for qualified private K-12 costs doesn't count as a qualified education expense. Each state offers their own 529 plan with varying tax benefits for that state, which, knowing how different tax rates are, like comparing California and New York to Texas, there are different benefits. In general, the tax benefit of a 529 plan is that you make a contribution, potentially receive a state income tax deduction up to a certain dollar amount, and then once the money is in the account, it grows tax-free, and when you eventually withdraw it, assuming you use that money to pay for qualified education expenses, you're able to withdraw it tax-free as well. So similar to a health savings account, it's one of the only accounts with a potential triple tax benefit, at least from a state tax perspective, since there are no federal tax deductions on the front end. And like I said, when it comes to the tax deduction for 529 contributions, the amount varies by state. But for Michigan, you're allowed to deduct up to $10,000 of contributions each year for state income tax purposes. So with the Michigan state income tax rate of 4.25%, there's potential to save up to $425 of taxes each year just by contributing to a 529. So the maximum allowable state tax deduction is $10,000, but that limit is based on how you file your taxes. If you're a married couple filing taxes jointly, you're eligible to contribute the full $10,000. Whereas if you're a single filer or married filing separately, you're only eligible to deduct up to $5,000 from your Michigan tax return. It's also important to note that in order to receive up to the $10,000 Michigan tax deduction, you must live in Michigan and contribute to Michigan's 529 plan, which is the Michigan Education Savings Program, or MESP. Each state has its own 529 plan, and these are run on a state-by-state basis. So unlike the first two items we covered in our tax planning checklist, employer retirement plan contributions and HSA contributions, where you can save on both state and federal taxes, for 529s, we're just talking about the state tax deduction. And when it comes to receiving that tax deduction, the 529 contribution doesn't have to be for your own child. You can contribute as a parent, grandparent, aunt, uncle, or friend and still receive the deduction. So Trent, I'm just going to double down here again. And as an uncle, you can contribute for your nephew.
Appreciate you reminding me. I think I might prioritize the 529 contributions for my own 4 kids, but I'll definitely keep that in mind for anything left over.
Fair point. And I don't think Grant will have a 529 contribution on his Christmas watch list.
That seems unlikely, although I guess with a financial planner as a dad, you never know.
We'll give him a couple years. And outside of being able to contribute on behalf of others, which keep this as a reminder out there for you, Trent, but there are certain cases where you can even contribute for yourself and receive a benefit. I referenced this earlier, but there was a change in legislation a few years ago that allows you to open a 529 and contribute for yourself if you're then using that money to pay back student loans up to a $10,000 lifetime limit, since this is now viewed as a qualified education expense. And as with most things in tax planning, you wouldn't want to contribute to a 529 plan solely for the tax benefit. And the way we approach college planning for clients is that we always first start with understanding the goal in terms of how much the child's education you want to ideally pay for, and whether you're thinking about public or private school, and then running projections to understand what impact different savings amounts would have on that projection, or what savings amount would be required for the particular goal, and then deciding from there what makes sense for your personal situation. However, if you're planning to save for college anyway, or if you already have a 529 plan that you're contributing to, as we approach the end of the year, it's worth reviewing your year-to-date contributions to see if you have any remaining space available that you could fill up to save additional money from your tax bill. And one last note on the 529 contributions as it pertains to the tax deduction. The Michigan state tax deduction is based on the net contributions to 529 plans for the calendar year. In other words, if you contributed $10,000 in 2021 and withdrew $10,000 in 2021, you'd have a $0 net contribution and thus not have anything eligible for the deduction. So you want to be aware of the timing, like contributing at the end of the year in one year and then withdrawing it in the next year.
Why can't they just make some of these areas straightforward?
I know, right?
Well, switching gears again, the next item we want to touch on is charitable contributions. And similar to college savings, we have an entire episode dedicated to charitable giving and ways to maximize the tax efficiency of your giving, episode number 23. So we'll touch on some high-level points here, but be sure to check out that episode if you want to dive into more of the details and some of the specific strategies. But when it comes to charitable giving as part of our year-end tax planning checklist, the first thing you want to do is look at your situation and see what types of options you have with your giving based on your financial situation and your charitable intentions. As we discussed in episode number 23, if you're someone who takes the standard deduction when filing taxes, you generally won't receive tax credit for charitable contributions until you get above the standard deduction threshold. Although there's an exception to this if you're 70 and a half or older, which we'll touch on in a second. But even if you do take the standard deduction, for 2021, there's a unique opportunity. When Congress passed the CARES Act in response to COVID back in 2020, it contained a special provision allowing people who take the standard deduction to still deduct up to $300 of cash gifts made to charity. For 2021, this was extended, and the amount was also increased to $600 for married couples who file taxes jointly. So even if you aren't usually able to deduct your charitable contributions for tax purposes, for 2021, you can deduct up to $300 if you file taxes single or married filing separately, or $600 if you file taxes married filing jointly. And just to note, when the IRS refers to cash gifts, it doesn't mean actual physical cash. This could be a check, credit card donation, etc. So that's one thing to check on for 2021. And if you are charitably inclined and haven't made that $300 or $600 of contributions so far, it's worth considering that as we head toward the end of the year, especially into the holiday season. Another potential opportunity for people who take the standard deduction and are age 70 and a half or older is qualified charitable distributions. This is money you donate directly from an IRA to charity, and doing so allows you to avoid paying taxes on the money. So while you would normally have to itemize your deductions to receive credit for tax purposes, qualified charitable contributions made from a pre-tax IRA allow you to receive an indirect tax benefit for your contributions, even if you take the standard deduction. This indirect tax benefit comes into play because once you turn 72, you have to start withdrawing money from your IRA accounts, whether or not you actually want to, which is referred to as required minimum distributions. So if you don't need the full amount of these withdrawals to fund your lifestyle, donating some of the amount directly to charity is an easy way to help satisfy the requirement while also fulfilling any charitable intentions. By doing this, it allows you to make your charitable gifts and reduces the amount of money you'll need to report as taxable income, which further reduces your net tax bill for the year. Just for reference, the maximum annual limit for qualified charitable distributions is $100,000, so that's a lot of potential giving space. So that covers a couple year-end charitable tax planning opportunities for people who take the standard deduction, but for people who itemize their deductions for tax purposes, there are even more options and flexibility with charitable contributions. If you are one of these people, we'd encourage you to review your year-to-date charitable giving prior to year-end so you can evaluate how much you've given so far and whether there are any other gifts you'd like to make before the end of the year. Specifically, one thing worth considering this year is donating appreciated investments if you have a taxable investment account, which is also known as a brokerage account, individual account, or joint account. The way it works when you donate appreciated investments is that you receive a tax deduction equal to the value of the investments, but you don't have to pay taxes on any underlying gains, and neither does the charity you're donating the investments to. So it essentially provides a double tax benefit for you and is therefore extremely efficient. For example, if you wanted to give $1,000 to charity, you could give $1,000 of cash or $1,000 of stock or investment. Looking at this example, you'll have the same tax deduction from a charitable perspective, the $1,000 you give, but you'll save more by giving a stock or investment that has an underlying gain associated with it. If you bought an investment for $500 and it's now worth $1,000, when you sell that investment, you normally have to pay taxes on the $500 of gains. However, by giving it to charity, you avoid taxes on that gain altogether, since the charity doesn't have to pay taxes when it then sells the investment. So you stretch how far your $1,000 gift goes by using appreciated stocks or investments versus just gifting cash outright. And the reason we highlight this now is that the stock market's done extremely well in recent years. So if you have a taxable investment account, it's likely that you have investments with significant gains. So now is a great opportunity to take advantage of the market's strong performance by using this charitable giving strategy.
So the last item we want to cover with our year-end tax planning checklist is slightly different because unlike all the other items we discussed, which are opportunities to lower your tax bill, this one doesn't directly lower your tax bill, but it does help to optimize the tax efficiency of your situation. And what we're talking about here is making backdoor Roth IRA contributions. Just to give a quick overview, an IRA is an individual retirement account. So it's a retirement account you can save to outside of your employer's retirement plan. And the way a Roth IRA works is that you contribute money to it with after-tax money, aka you don't receive a tax deduction for your contribution. But once the money is in the account, it then grows tax-free, and you never have to pay taxes on it again, assuming you make a qualified withdrawal when you eventually withdraw it. So it's a tax-efficient way to save for retirement, and it's part of the tax advantage space that we're talking about filling up when we look at saving for retirement. Now, the one stipulation is that there are income limits involved with contributing to IRAs, and if your income is above a certain level, you're not allowed to receive a tax deduction for contributing to a traditional IRA or contributing directly to a Roth IRA. So as a physician, you're likely above the income limit and aren't able to contribute directly to a Roth IRA or receive a tax deduction by making a traditional IRA contribution. However, there's a workaround known as the Backdoor Roth IRA, which involves making a non-deductible contribution to an IRA. For example, you don't receive a tax deduction for it, then immediately transfer that money, or quote-unquote converting it, to a Roth IRA. There are some additional nuances here, such as certain reporting requirements for filing taxes and potential issues you could run into if you try to do this while having an existing pre-tax IRA balance, but it's another potential account to save to and receive a tax benefit from. So you want to confirm your specific situation with a tax professional before making a backdoor Roth IRA contribution. And just to provide some perspective, the current annual contribution limit is $6,000 if you're under age 49 or $7,000 if you're over age 50. So the final item in our year-end tax planning checklist is confirming whether or not a backdoor Roth IRA contribution makes sense for you and making it if it does. Now, one thing worth mentioning here is that since it's existed, the backdoor Roth IRA has always been somewhat of a loophole in the IRS tax code. And the reason it's viewed as a loophole is because the IRS has income phase-out limits for making direct Roth IRA contributions or for getting a tax deduction for traditional IRA contributions, yet have explicitly blessed following this backdoor Roth IRA strategy, which is effectively the exact same thing as making a direct Roth IRA contribution. And I know it's really surprising that something in the tax code doesn't make intuitive sense, but there's always potential that the backdoor Roth IRA loophole could be closed at some point, and this was even discussed in the recently proposed tax legislation, where there was initially an item prohibiting the conversion of after-tax dollars into Roth accounts beginning in 2022, which would effectively eliminate the ability for high-income earners to make backdoor Roth IRA contributions. As of the time of recording, this part of the legislation has been removed. However, the legislation is still in draft form, and it's unclear what the final version will look like. So while you normally have until April 15th of the following calendar year to make your backdoor Roth IRA contributions, if you're planning to do it for 2021, you might want to consider making your contribution and conversion before calendar year end, just to hedge against the risk that the final version of the tax legislation bill includes an element that ends the backdoor Roth IRA as of December 31st of this year.
So that covers our year-end tax planning checklist, and hopefully this was helpful with providing some tangible options and action items when it comes to optimizing your tax situation before the end of the year. When it comes to tax planning, as Andrew mentioned at the beginning, we always make the point that you should never let the tax tail wag the dog. In other words, you shouldn't do something solely for tax purposes if it doesn't make sense within the context of your overall financial life and financial plan. However, if you have the opportunity to save on taxes with something that's aligned with your situation and goals, that's the ideal scenario. Also, we always have to mention for compliance purposes that none of what we discuss represents tax advice, and we always recommend consulting with a CPA or a qualified tax professional to see whether these strategies make sense for you personally before implementing any of them. And just to give a quick recap of the items in our year-end tax planning checklist, so number 1 is employer retirement accounts. So consider making pre-tax contributions to fill up the available space in your employer's retirement savings accounts, whether that's a 401k, 403b, 457, etc. The 2021 maximum employee contribution limit per account is $19,500 if you're 49 or under, and $26,000 if you're 50 or older. Number 2 is a health savings account. If you have access to an HSA, consider contributing to receive the tax deduction and then have money available to either pay for out-of-pocket healthcare costs or invest for retirement. The 2021 HSA contribution limit is $3,600 for an individual and $7,200 for a family. And that's combined employer and employee contributions. Although there's an extra $1,000 catch-up contribution allowed if you're 55 or older. Number 3 is a 529 college savings plan. If you're saving for college, keep in mind that you can deduct up to $10,000 of contributions to the Michigan 529 plan for state income tax purposes each year. So that's an easy way to save $425 on state income taxes if you're saving for college anyway, or paying back up to $10,000 of student loans. Number 4 is charitable contributions. If you'll take the standard deduction when filing taxes, you can still deduct up to $600 of cash charitable contributions for 2021 if filing taxes married filing jointly. And if you're age 70 and a half or older, you can do qualified charitable distributions from your IRA to save on taxes that way. On the other hand, if you'll itemize your deductions for tax purposes, you'll want to review your charitable giving activity for the year and might want to consider taking advantage of the strong stock market performance by donating appreciated investments from your taxable investment account if you have one. And lastly, number 5 is the backdoor Roth IRA contribution. If it makes sense for your situation, consider making a backdoor Roth IRA contribution to improve the tax efficiency of your retirement investments. And if you are going to do it, consider making your contribution and conversion before year end to hedge against the risk that the current draft tax legislation outlaws the backdoor Roth IRA beginning in 2022. Well, thank you as always to everyone for joining us for another episode of the show. You can find the show notes and the links to those prior podcast episodes we mentioned at the podcast page of our website, mdwmllc.com/podcast. And if you have thoughts to share or questions you'd like to have answered, you're welcome to email us at info@mdwmllc.com. Take care, everyone, and we'll look forward to talking to you again soon.
Want even more ideas, tools, and resources on how to make smart financial decisions? Check out the resources section of MD Wealth Management's website at mdwmllc.com, where you'll find additional knowledge and insight from Michigan physicians, including a blog, ebook, and one-page guides. While there, you can also schedule a 15-minute conversation with Andrew and Trent to learn more about what it means to work with the firm and how they serve physicians. If you've enjoyed the content, please leave a review on iTunes and share with your friends and colleagues. Thanks so much for listening. Andrew Mushbaugh and Trent DeBruin are certified financial planners, principals, and co-founders of MD Wealth Management, a registered investment advisory firm in the state of Michigan. All opinions shared in the show are for general information and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and no guarantee of future returns. Please consult with your legal advisor, your tax advisor, or your financial advisor before making any decisions.